Target outcome investments are investments that seek to give you a level of certainty in your investments, right? So investments classically have been just looked at from a risk-return perspective, but we think they should be looked at from an outcome perspective, which is, at a specific point in the future, relative to a specific reference asset, let's say the market as a whole, investors are looking for some degree of downside protection and some degree of upside capture. And we create investments, or target outcome investments, are investments that take that concept of outcome and target that and develop an investment strategy to maximize the possibility of achieving that target. Flex options are quite like the standardized listed options in a sense that they are listed and trade on an exchange, and their price discovery is through an exchange auction mechanism. But they're different from standardized listed options in a sense that you can customize certain key elements of the option. You can customize the strike price of the option, you can customize the expiry date of the option, and you can customize the style, whether it's an American style or a European style of the option. And that ability allows us to create really high definition targeted outcomes, which are just not possible with standardized listed options. One element that investors have had to grapple with over the last few years of sell-off is the lack of certainty in their investment outcomes, right? Like, even though you might be saying we're going to capture 40% of the upside and 20% of the downside as an example, or this has a low vol, the uncertainty that it's creating in the portfolios is high. And there is utility for investors to get investments which very well define their outcome. So as an example, there are investments, we recently launched ETFs, which give you access to the S&P 500, where you're protected on the downside from, let's say, 0 to 10%, or from -5 to -30%. And that degree of definition allows to deliver a higher degree of certainty in clients' portfolios, which is why in times like today, when markets sell off like 3.5%, this certainty is very welcome. Yeah, so target outcome strategies, although they're not known as target outcome strategies, have been available in other formats, in form of structured notes or structured annuities. And one of the key components of that is that there is an entity, either a bank or an insurance company or some financial institution, which is using its balance sheet to provide a guarantee on the outcome. And that can be a good thing most of the times, but sometimes when the financial institution goes through a credit crisis, or whether the credit of that specific financial institution comes into question, the entire investment can crumble because of a possibility of a issuer default. Target outcome investments in a 40 Act fund sidestep that by not having that credit exposure to a financial institution. They're backed by the securities which are held inside the 40 Act fund. And then other benefits are, you get daily liquidity, which is a legal requirement of a 40 Act fund, in contrast to a structured note or an annuity where you're locked up for like 7 years. You get potentially different and better taxation. You get transparency around the holdings and the cost. And so those are, some remarkable factors which have worked very well for the 40 Act space in general, now can be delivered to target outcome investments. RMC is like a one-of-a-kind event in our space. It's known for its high quality of content and the participants that come to the conference. There's so much to learn from them. And I think the Cboe team does a phenomenal job in putting together a great event and ordering the best weather. Yeah, so it's great to be here.